Welcome back to Behind the Quote. Today, we'll be diving into the fascinating history of the term bank run. Get ready for a roller coaster ride of fear, panic, and of course, a few laughs along the way. So, what is a bank run? A bank run is a phenomenon where a large number of customers withdraw their deposits from a financial institution all at once, usually due to fears that the bank is about to become insolvent. This mass withdrawal can, in turn, cause the bank to go bankrupt. Some of the most notable bank runs in history include those that occurred during the Great Depression and the 2008 financial crisis. These events not only affected the banks, but also had lasting impacts on economies and people's lives. The term bank run can be traced back to the 19th century when banks were first established. The phrase was coined to describe the panic that ensued when depositors rushed to withdraw their money en masse, fearing the bank would collapse. Let's break down the mechanics of a bank run and explain the chain reaction that leads to the collapse of a financial institution. Banks operate under a fractional reserve banking system, meaning they only hold a small percentage of their customers' deposits as reserves. When a large number of customers withdraw their funds, the bank's reserves quickly dwindle, forcing the bank to sell assets at a loss or even face insolvency. Now that we've laid out the foundation, let's explore some interesting stories surrounding bank runs. Spoiler alert: there will be drama. In this section, we'll explore some of the most famous bank runs in history, from the Knickerbocker Trust Company collapse in 1907 to the Northern Rock crisis in 2007. We'll also examine recent examples in 2023, such as the viral bank run on social media, where misinformation about a bank's stability led to a sudden rush of withdrawals, and the collapse of SVB Financial Group, as reported by CNN and CNBC. These modern examples highlight the role that social media and technology can play in exacerbating bank run risks. In the case of the Knickerbocker Trust Company, the collapse was triggered by a failed attempt to corner the copper market, which led to a loss of confidence in the bank. The subsequent panic resulted in a massive bank run and eventually a financial crisis. The Northern Rock crisis in 2007 was one of the first signs of the impending global financial crisis, with depositors lining up outside branches to withdraw their money. As for the 2023 examples, the viral bank run on social media showcases the power of misinformation and the rapid spread of fear through digital platforms. In the case of SVB Financial Group, an article published by CNBC revealed that a research paper suggested the bank's collapse was fueled by social media, leading to increased bank run risks in the digital age. To prevent bank runs, governments and central banks have implemented various measures, such as deposit insurance and emergency lending facilities. Deposit insurance protects depositors' savings up to a certain limit, providing assurance that their money is safe. Emergency lending facilities, like the lender of last resort function performed by central banks, can help provide liquidity to banks in times of crisis, preventing a chain reaction of bank failures. That's it for our deep dive into the world of bank runs. We've learned about the origins of the term, the mechanics behind bank runs, and some famous examples throughout history. It's important to remember the impact that bank runs have had on economies and people's lives and the steps taken to prevent them from occurring. Thanks for joining us today, and don't forget to like, share, and subscribe for more videos.